simplest and easiest ways to get started with investing is using the free ETFs that most brokerages will give you. They are commission-free trades, so you can buy one share at zero cost and you can sell it at zero cost. So that it really explodes the potential for different strategies because you don't have any cost to trade. So you can be pretty much, this strategy for me has evolved over time, over many years of trading free ETFs. And when people ask me or they want to get started investing, I say just start buying free ETFs. Just buy two each week or each paycheck. And after a month of that, start buying 3 and selling 1. Very simple. You're constantly growing your portfolio because you're always buying more than you're selling. You're making a sustainable level of investment. You're doing this over time. You're selling stuff that's possibly out of favor or maybe using momentum. I'm using momentum in mine. So I'm selling the low momentum and I'm buying the high momentum, and I'm also buying other opportunities like things that are possibly out of favor that I think are going to go up again, which in dollar cost averaging is pretty much all ETFs. So I have this huge array of what I'm buying and what I'm selling, and I grow that incrementally, and I'm constantly buying more than I'm selling, and it really works great. It has a tremendously consistent return in any market. The actual return is not predictable because I'm using the default first in, first out when I sell my shares. I don't care about the actual share costs that I'm selling. So to me, to my reporting, it's different all the time. Sometimes it's much greater, sometimes it's much smaller. I'm using the average cost to determine the cost. And so, that is always not completely accurate. Sometimes I actually sell a position that results in a realized loss. This is very rare. Not really too concerned with that. Definitely am not interested in the administrative burden of worrying about all of that. I just would take that loss and move on. So this huge amount of volume of trading and buying and selling results in consistent realized gains and tremendous market exposure and a incrementally and consistent, sustainably growing portfolio. So here is my step-by-step instruction on that part.
Okay, the first thing I do is figure out my contribution amount. Let's just assume that it's $200 for each period. The next thing I do is figure out a threshold for the buying amount. I usually would use 3 times the contribution amount. And then I look at my brokerage cash. Let's pretend it's $2,000. So then the buying amount, the cash is less than the threshold, and invest all of the cash. If it's greater than the threshold, then I invest 50% of what is over the threshold, plus the entire threshold. So I would be buying $1,300 worth of stock today with $2,000 in my brokerage account. So the first area I contribute to is the negative, the worst performing. Because these are ETFs, they're going to come up again. These have always worked out great in the long run, but you don't want to throw good money after bad, so I just do 20%. So I contribute $260 to the lowest performing positions in my account only if they're less than 5% off of the market price. I'm not interested in putting this money towards even or positive investments because it's actually going to negatively impact the average cost. Whereas if the positions are far off of the market price, this will actually improve the average cost and it will get them more into the market range. So this is an opportunity. So I contribute $260 to the worst. Now with the remaining, I'll put 20% into the mutual funds. I use depending on what kind of account it is how I would have my mutual fund allocation set up. I have several videos on how to allocate your funds if this is a rollover account or if this is a taxable account. And that leaves $832 that I will be applying to a momentum scale. So what I'll use is moving averages, these very short moving average compared to actually to a current market price, just to get a very rapid momentum measurement. But before I would do that, I would flag the bottom 20% momentum ranked investments, because ranking momentum rewards volatility. So by flagging the worst performing momentum positions, I'm able to put them into a handicap area where they will be flagged for the next 4 periods, and so this money won't be applied to them until they can not be in the bottom for that long. So once I've determined that the position has not been in the bottom 20% for the past 4 periods, then I just look at the top momentum winners. So these are the top 8 momentum stocks, or ETFs, that have not been in the bottom for the past 4 periods. And I obviously could extend the rank down to accommodate $832, but I would rather concentrate the buying, so I just use 15% of the 20% that's been flagged, which is 8. So I'm using these fractions because the strategy has evolved over time and included much more, and I needed to scale it up or scale it down in certain directions. So I've grown used to using 8 as the number that I will contribute to. So it'll most likely be approximately 4 shares of this, of each position. So I'll be buying 32 shares, and then I'll go look at my sell. I'll add everything that I'm buying from here and from the worst, and I'll put those on a buy log, just similar to the volatility log. And with the buy log, I'm measuring positions that I have not purchased within 30 days. So I'll end up with a list of stocks that I've held for over 30 days and haven't purchased or contributed to in that time. And then I'll make sure the realized gains based on the average cost of these positions is over 0. And after I have that, so basically I'm holding shares, I haven't purchased them for 30 days, and they're in the black, they have a positive return, then they're eligible to be sold. And when I go to sell them, let's say I have 6 shares, let's say I have 6.4 shares of a position. I use the formula square root, and that's just how many and then I use the formula integer. So it comes out with the number 2. So I will sell 2 shares of this position. That way, if I happen to have a stock with a very large position, I don't really know how to divide the shares up, if I should sell them all at once, if I should sell the fraction over a bit. I've really grown comfortable and had great success using the square roots. So I use the square root, and it always produces a whole number. And if there's 2 shares, it says 1. And if there's 1 share, then I sell it all. So it works very good with the small numbers, and it has a strategy to the large numbers. So it really works great. So it comes out with the number to sell 2. So I'll go through and I'll sell all of the positions that meet that criteria. That, I have the shares, it's in the black, and it's been over 30 days. And it'll come out to be a huge list. It'll be way more than 8. It could be like 16 positions. Now add up the number of what I'm selling, these 2s and 1s and 4s and 6s, and it comes out to be, let's say 28. So I'm selling 28 shares. But over here, buying 32. So the differential here is 4. And I look at my differential based on my account, my cash balance, which was 2,000, and I usually use a differential to manage my cash. I'll use a differential that's equal to the thousands. So if my cash balance falls under 1,000, it's 0. If it's over 1,000, it's 1, and if it's over 2,000, it's 2. So my differential is only 2 because my brokerage cash is at 2,000. Well, here I have a differential 4, so I want to actually buy less. So I'm going to make these bottom two 3s, which makes my total 30. So now my differential is 2. So I'm only buying 2, or I'm only buying 3 each of these bottom 2, and these top of the rankings are getting 4s. 4, 4, 4, 4, 3, 3. And I sell the long list of what's eligible to be sold, and I get 28. So I'm using the square root formula to prevent damaging any substantially damaging any positions. I'm using the differential of what I'm buying and selling to manage the cash. And by keeping these consistent over a long term, there's always cash available and there's always shares available. Now, if the market would happen to go down, a lot of these positions would grow negative and I would have much less to sell. In that case, this will be, the buying amount will simply decrease, which would maintain the cash. Obviously, if that is prolonged, it will substantially damage the cash available in the account, but that's the point, is to get down, is to have it last long through the downturn. And in the worst case scenario, which has never happened, I would just simply be using the contribution amount 100%, which is $200, and just investing that into the 2 or 3 or 4 or 5 shares that I could buy off of this and selling nothing. And I would just do that period in, period out until I have eligible to be sold. And like I said, that's never happened, and when the market does go way down like that, something else goes up, so you end up with positions to sell no matter what the market's.
So it wouldn't work without the free ETFs. Several brokerages offer them. I have several different brokerages to take advantage and to increase my exposure to these wonderful products.